Adding to market worries, an inversion at the short end of the U.S. yield curve raised the specter of a possible U.S. recession, Reuters reported. The sell-off appeared likely to extend into European trading, with spread bettors expecting London's FTSE 100 to fall 0.2% at the open, and both Frankfurt's DAX and Paris's CAC 40 to fall 0.4%. MSCI's broadest index of Asia-Pacific shares outside Japan was 0.3% lower. Australia shares gave up 1% for the day and Seoul's Kospi ended 0.8% lower. Japan's Nikkei stock index tumbled, closing 2.4% lower on profit-taking and as foreign investors and hedge funds reduced their positions on risky assets. But Chinese blue-chip shares in Shenzhen and Shanghai added 0.2% after struggling to break into positive territory for much of the day. The temporary freeze on further hostilities in the trade war between the U.S. and China had sparked a global rally in equity markets on Monday, pushing MSCI's All-Country World Index up 1.3%. But even before the trading day ended, major U.S. indices pulled back from intraday highs on skepticism that Washington and Beijing can resolve their deep-seated differences in the three-month negotiating window that was agreed, after which tariffs could escalate again. It seems that more details and signs of progress will be needed if the initial trade truce warm fuzzy feeling is to be sustained, National Australia Bank analysts said in a note to clients. Already, there was confusion over when the 90-day period would start. A White House official said it started on December 1, while earlier, White House economic advisor, Larry Kudlow, told reporters it would start on January 1. Moreover, none of the commitments that U.S. officials said had been given by China, including reducing its 40% tariffs on autos, were agreed to in writing and specifics have yet to be hammered out. The fear across global markets is that this is just a short-term relief rally and we will find ourselves back where we were a few weeks ago and staring down the barrel of a long-term global growth slowdown. Nick Twidale, Sydney-based analyst at Rakuten Securities Australia, said in a note. Adding to worries over the outlook for the global economy, the yield curve between U.S. 3-year and 5-year notes, and between 2-year and 5-year paper inverted on Monday, the first parts of the Treasury yield curve to invert since the financial crisis, excluding very short-dated debt. Analysts expect an inversion of the 2-year, 10-year yield curve, seen as a predictor of a U.S. recession, to follow suit. On Tuesday, the yield on benchmark 10-year Treasury notes was at 2.9515% compared with its U.S. close of 2.991% on Monday. The 2-year yield also fell, but by a narrower margin, touching 2.8109% compared with a U.S. close of 2.833%. That put the spread between 10-year and 2-year Treasuries around 14 basis points. Earlier in the day, the spread hit its narrowest level since July 2007. The market pricing evident in the yield curve inversion from 3 to 5 segment of the curve, as well as the dip in the 10-year yield below 3% yesterday, goes to reinforce these concerns about the U.S. economy potentially heading into a recession, said Prakash Sakpal, an economist adding in Singapore. However, he added that solid U.S. manufacturing data released on Monday pointed to a stronger economic outlook, with new orders a key driver in boosting activity. In contrast to faltering Asian equity markets, oil prices continued to rise after surging 4% the day before on the U.S.-China trade truce, and ahead of a key OPEC meeting expected to lead to supply cuts. U.S. crude was 1% higher at $53.46 per barrel, and Brent crude futures gained 0.9% to $62.26 a barrel.